being the weight of capital being committed to some of these funds. Importantly, these savings are directly to the SIC's bottom line, 100%. Townsend in no way benefits from these fee savings at all. And most importantly, the portfolio, as I mentioned in the previous slide, is consistently outperformed outside of this last couple quarters of the COVID environment by investing with really strong managers, quality managers, at the same time being able to reduce the portfolio's overall fee load. The last slide I'll talk about, and skipping ahead a bit, because Paul covered a couple of these already, is slide 80 within your report. And this is what we call the PME, or the public market equivalent slide. And given the volatility we've seen in the public market, so this is a slide that I've focused on a little bit more regularly recently. And you can see here in both cases, whether we're looking at the full inception period of the portfolio or the rebalanced portfolio since 2011, you do outperform that public market equivalent. And this is despite really that volatility we experienced in 2020 and the significant rebound that the public markets experience, and real estate tends to lag that, but we still do outperform the public index. I'll stop here. There's a lot of other slides in here. I know in the past I've mentioned we've included some fund-specific performance. Paul mentioned in his comments some of our retail exposure that has driven some of the negative results. That is on slide 76 and 77 in more depth, sort of the drivers of some of the recent performance. But I'll stop here and open up to any questions.
Now, Madam Chair, I think you suggested that we go through the real return PMR first and then come back to questions.
No. I'm sorry.
Okay.
Let's see if there are questions on the real estate.
Sure.
No, Paul, I just meant rather than stopping between your presentation and Townsend's,
Sure.
do both, and then we'll stop for the actual asset class.
Terrific.
So questions from council. Okay, so we'll move on to agenda item 2E, real return.
Very good. Thank you, Madam Chair. So this is the real estate, the real return PMR, excuse me. And, there's no hiding it. The real return and real asset returns over all time series are a big disappointment. If you look at the report in front of you, the portfolio is made up of 5 strategies: infrastructure, timber, agriculture, energy, and financial assets. And that financial assets bucket is currently mostly MLPs, although we're going to be talking about two Berkshire funds later on this morning that will go into that same financial assets portfolio. Of those five portfolios, or those 5 strategies, it's really only infrastructure that's doing its job. But other than the MLP portfolio, which is some public equity, the ability to pivot this portfolio is really limited because virtually everything sits in closed-end funds. But there's hope, because if you look back at the 12/31 of 19 real return PMR, the 3-year net IRR for the real asset portfolio was 6.3%, and energy was contributing 8.2% net return. So what a difference a year makes. But I think we're going to see some turnaround in this real asset portfolio, the real return portfolio. I know that in the fourth quarter, which we're not going to be reporting for another probably 4 months here, MLPs were up 25%. Since the end of the year, they're probably up another 10%. We've had calls with many of our energy managers, and they're marking up their assets now. So ahead of us, an improvement in returns, at least in the energy segment. So this PMR covers quarter 3. And as I mentioned, I think we're going to have some more brighter things to report when we do the quarter 4 report. But in the meantime, staff with Townsend's support is also working on a structure study that will lay out a plan to enhance returns in the real return portfolio. And one move, as I mentioned earlier, is to do some strategies similar to the Berkshire real estate debt funds that we'll be talking about later, that will provide both some more of an income orientation to that portfolio, but also diversification away from just the MLP holdings. want to cover the Townsend take on the PMR.
Sure. Thanks, Paul. So again, I'll jump into performance drivers and what's really happening here in the portfolio. I'm going to start on page 108 of your book, showing both the real return and the real assets performance. So we've talked about the MLP performance. Just to give some context to these numbers. So in the first quarter of 2020, the MLPs alone generated a negative 49% quarter. Then in the second quarter, a positive 33%. And then just now in the third quarter, reporting here, a negative 9%. As Paul mentioned, we do have some values into the fourth quarter, and we saw MLPs up about 20 to 25%. So all being said, MLPs for the 2020 calendar year delivered a negative 25%, which is really driving the underperformance across all measurement periods when you look at the real return. So maybe to take a step back, the real return bar in this chart includes financial assets, includes the MLPs, whereas the real assets includes just those private asset classes of energy, infrastructure, agriculture, and timber. So for the reason of this volatility, as Paul mentioned, we're going to talk a little bit about two maybe less volatile, more income-driven return funds later today for commitments of about $100 million combined. So importantly, that second bar, which strips out the MLP portfolio, includes those sectors I mentioned. These investments have performed better, although are still underperforming the current CPI plus 300 benchmark, which we'll talk about in a moment. Given we here at Townsend primarily focus on these real assets exposure, specifically infrastructure, timber, and ag, with energy covered by both your staff and some other consultants. Outside of the first two slides here in the presentation, the metrics are entirely based on the real assets portfolio. So as stated in the summary, and I'm looking at page 110, our allocation at 3Q was 7.3% versus the 9.6%. Our VK mentioned this was under the target exposure, under the below the range, and it's being considered for a reduction. Importantly, this allocation is relatively unchanged quarter over quarter, highlighting that the portfolio value increased alongside the broader total portfolio. So as I mentioned in real estate, the real estate portfolio exposure decreased a little bit because of equities outpacing really real estate. Here in the real assets portfolio, we had over $43 million of capital contributions for new investments, another $41 million in asset appreciation and income. Now this was slightly offset by some distributions and fees, but the portfolio really held consistent allocation quarter over quarter. Lastly, during the quarter, subsequent really to the end of the third quarter, two investments were approved, combined for $175 million. These were approved both within the infrastructure sector, which, as Paul mentioned, has really been the bright spot in terms of sector performance. The two performance charts that I want to talk about are in slides 112 and 113. As mentioned today and discussed in prior meetings, through the structure study and both New Mexico staff and your general consultant are in process of evaluating alternative indices and benchmarks, given the lack of a true valuation change when comparing an index to the CPI. However, at this time, that's what we are compared to, so we're showing that portfolio performance on slide 112 when we're done over a different time period. You see there the underperformance over the 1 year and the 3 year. The quarter closely tracks. We'll underperform about 20 basis points, and we see slight outperformance, 10 basis points over that 5 year number. When we look at the portfolio drivers, so that's slide 113, as we've mentioned already, consistent with history, infrastructure remains the primary driver of performance along with timber. And then both agriculture and energy have really equally impacted the portfolio to a negative degree. The volatile energy market remains just that, volatile. The portfolio was slightly positive in the third quarter, however, significantly negative in the first quarter. So year-to-date performance of the energy portfolio is down about 20%, which is really driving the overall total return here, regardless of what positive attributes we're seeing from the other asset classes. I think I've mentioned these in the past, but I do want to just highlight that the volatility of the energy is not just the COVID environment. But what we saw when we started the energy portfolio back in 2012 is out of the gate, The portfolio generated a 15% return in the first year, a 10% return in the second year, and then 2 negative years of -6, -10, followed by a +27, a +18. So we're seeing this volatility repeat itself, and as we've seen about 9 years of performance within the energy portfolio. The other portfolio that is negative here is agriculture. So over that 3-year period, we have been impacted by currency. So about 24% of the agriculture portfolio has exposure to South America, primarily Brazil, where in 2020 alone, the currency was devalued by about over 20%. And for those that follow the currency markets, the Brazilian real there has depreciated every year since 2011. So we are seeing that impact our performance. But similar to the energy, the ag portfolio also experienced significant declines in the first quarter, really impacting ag returns over all periods. So as we reviewed in prior quarterly reports, the onset of COVID really shifted expectations for agricultural commodities. Mostly suffering declines, expanded production, and really subdued demand put pressure on prices across all major crop types. Additionally, we saw a decrease in transportation fuel, ethanol, so that put pressure on both our corn, soybeans, and sugar exposure. And then a sharp decrease in restaurant demand led to some other shifts in crop markets. So as we started doing prior to this year or early in 2020, we again include performance summaries on some of the more impactful funds. This is highlighted on slide 115 and 116 of your report. And the other slide I did want to just touch on, and I mentioned this at the CIC, is slide 114. And here we show significant events. And typically, there's changes throughout each of these funds on a regular basis, whether it's small amendments or changes to teams. But we really typically see sort of a limited concern or an ongoing event that when there's a portfolio manager change. Here we are highlighting one fund with a red, the color red, sort of a green, yellow, red categories. So ACM is listed as a concern level of red. It's not concerning overall on the fund investment, but there is some ongoing restructuring that ACM is proposing. This is an agricultural fund that is looking to roll up and combine 2 existing funds. I would just mention that your staff, Paul particularly, is very involved in this, as is Townsend, and we're closely monitoring. We sit on the LPAC for the fund, so we're deeply in talks with ACM. But just wanted to highlight that, given we don't typically see a major event or a red concern on this page. The rest of the slides, I'll leave to questions. There are many of them you've seen before. That I'll stop here.
Thank you, Seth. Questions on real return?
Madam Chair, this is Harold. We spend a fair amount of time at the investment committee meeting talking about this particular asset class and part of the portfolio, and Seth's done a great job and Paul have done a great job covering it. We're going to keep our eyes on this. At the time we made the investments, it made lots and lots of sense, but we're going to continue to monitor this because it's a little concerning. But at the same time, I think that these are real assets, and from my perspective, I like that part of it. So we're going to stay on top of this.
Thank you, Member Lavender. Actually, for my part, I will say, just kind of piggybacking off of your comments, at the State Land Office, we had a presentation from a group called IEFA, the Institute for Energy, Economics, and Financial Analysis, specifically about energy markets. And, notwithstanding the regular cycle of boom and bust that these markets experience, they really just talked to us about sort of where capital is with some of these companies, and just kind of looking ahead to the future of where the fossil fuel market will be in the next few years to a decade. So I would like to recommend that this group come to perhaps an upcoming meeting of the SIC to present those same findings. They are a neutral third-party research firm, and so Steve, I can talk with you about that, how to schedule that. But I think that would be pretty enlightening for SIC members.
Thank you, Commissioner. We'll follow up with you.
Any further questions before we go on to David? All right. Thank you, Paul and Seth. So we're moving on now to private equity. We'll do first the National Private Equity quarterly PMR. And David, that's going to be you, and then you can turn it over to Mercer, and we'll take questions after that. So this is agenda item 2F, the third quarter performance report for National Private Equity.
Thank you, Madam Chair. Good morning to the council and to everybody else on the call. I am with Chris Cassidy is also on the line for the private equity staff, and we just wanted to provide a bit of a refresher. We do provide this performance update for the third quarter for both programs. The first part of it is actually summary information, but for those that are true masochists, we do also provide right behind each of these reports individual fund summaries broken out by exposure, by quartile, and by vintage year, and they're even color-coded for quartile performance. So, if anybody has any spare time, you can go ahead and look through about 110 funds there. The performance update for the national program starts on diligence slide 144, but I'm pretty sure that Mercer's going to jump right to 147. That's the first interesting slide. So with that, I'll turn it over to Mercer.
Thanks, David. Yeah, we'll start on page 147 of the materials. We're covering Q3 2020 performance today. As a reminder, performance is delayed for private assets, which is why we're talking about Q3 today. We did put in a new slide with an overview of performance because in this report, we often talk about since inception performance. We wanted to find some way to show the impact of more recent commitments on the portfolio. The challenge is it takes time for performance of recent investments to have an impact on the overall portfolio returns, since capital is drawn over time, and then it takes time for managers to add value to portfolio companies. So this table shows performance for funds with vintage years 2009 and before and 2011 and after. These dates correspond to when the SIC launched the new private equity strategy for the national program. One of the things you'll see is the 2011 and after funds have more influence on the overall returns with more recent time horizons, looking at the 1 year, 3 year, and 5 year, which makes sense since a lot of the value becomes realized in the older vintage year funds in the more recent years. But we still do not yet have 10 years of history with those 2011 and after funds. You can see that since inception is still influenced by the 2009 and before vintage year funds, since there's more history with those funds. Overall, looking at the overall performance on a 1 year to 5 year basis, it has been between 12 to 13% compared to the since inception net IRR of 11.5%. And if you look at the quarterly IRR of 8.6%, we have had another strong quarter of performance. And if you'll recall, for this year, we did see negative performance as of March 31st with the impact of COVID on the portfolio, but we've seen strong recoveries in the June 30th and September 30th performance, which is led primarily by the technology exposure in the portfolio. Turning to the next slide, this is the since inception performance slide that we've shown you in the past. Net asset value increased by $271 million. It was largely driven by another sizable valuation gain in the portfolio. Year over year, this table shows the impact on both the net multiple and net IRR. And that impact has been positive, with the overall multiple increasing to 1.50 from a 1.48, and the since inception net IRR increasing slightly to 11.5% from 11.4%. Looking at the strategies, buyout and growth continue to be the strong performers. Venture capital is lagging, but the national program hasn't done any until recently any exposure to venture capital. So a lot of those are legacy funds that we've been working to liquidate. One comment on the overall performance of the program: there has been nearly $5 billion contributed, with just over $4.6 billion being distributed back. And there's currently a valuation of nearly $2.9 billion, which equates to a gain of $2.5 billion from the national program. Moving to page 149, this graph shows the strong performance over the last 2 quarters that we've seen, with 195 million of gains in Q2 and 229 million of gains in Q3. And all strategies contributed to the gain this quarter. We also saw contributions continue to be strong, with 116 million called from funds and about 74 million returned from distributions. Looking ahead at Q4, we actually did see distributions come back quite strong, and that number ended up being 167 million in the quarter compared to 99 million of contributions. Slide 7 goes into more detail about what drove the contributions, distributions, gains, and losses. We continue to see a lot of sizable capital calls as managers remained active in making new investments. And many of the gains that you'll see in the table in the upper right were driven by technology companies or companies recovering from lower COVID valuations as their performance exceeded expectations. One of the drivers of the overall quarterly gain, too, was the lack of sizable losses in the portfolio during the quarter, which you can see in the lower right-hand table. Slide 151 shows a 5 vintage year look at the portfolio's performance against the Burgess Private Markets benchmark. In recent years, net multiple is above median in all years except 2013. 2013 is dragged down by a fund that did a considerable amount in energy, which is just barely positive overall. And we have not seen energy investments come back as we have with other industries. 2017 is also below median right now, but these funds are still early in their lives, so it's hard to make conclusions at this stage. There is particularly strong performance in 2014 and 2016, which have had over 1.1 billion of the remaining value right now. In particular, 2016 is driven by 3 managers with net IRRs greater than 20% and net multiples above a 1.7 times return. Going to the next slide, this shows the public market equivalent performance over the last 10 years. We did add the Msci Aque benchmark, which was a recommendation from Vince. The Aque index covers multiple countries and geographies, including the US, Europe, and Asia, which is actually similar to our focus in the national program, whereas the Russell 3000 and 2000 are focused on the US. The national program outperformed the Aque by 4.8%, but is under the Russell 3000 and just slightly above the Russell 2000, which the Russell 2000 focuses more on the smaller companies in the Russell 3000. Page 153 has a summary of the strategy and where we are with the different components of the strategy summarized on this table. We have a 300 million to 400 million annual pace. We hit that range in 2020 with 330 million closed. Through January, 1 commitment's been approved for 50 million, and we have two on schedule for March. And so we're going to be making good progress through Q1 towards the 2021 goal. From a sub-strategies and geography perspective, all are within target. Asia is at the lower end of the range, and we expect that will increase as capital is drawn from KKR Asia, which was approved last year. From the concentration standpoint, we still have 1 general partner above 10%, but with recent commitment activity and some realizations, the exposure is actually down to under 11% now. So that's becoming more diversified. And we still have 4 fund series above 5%, but this is a little bit more of a softer concentration because it's partially driven by performance reasons, with 4 of those fund series having net IRRs greater than 18%, which is what we want to see in this program. We have been disciplined with new managers over the last 9 years. 27 managers have received new commitments, and there's still a lot of older funds in the portfolio. And if you take out the 2007 or older funds, we'd be at 63 funds right now. But the value is definitely going down in the older funds as we see more realizations. The following slides have more details on these different strategy components, but I'll conclude there and open up with any questions.
Thank you, Richard. Sounds like great news. Yes.
And
on the national program. What did you say, David?
Well, I'm sorry, I was going to add that, and the fourth quarter looks even better. So we look forward to providing that in 3 months too.
Great. All right. Awesome. Great work, team. Let's go to New Mexico.
So for the New Mexico program, these slides start on diligence slide 172. And I think Richard will jump to slide 175 to start his comments. Go ahead, Richard.
Thanks, David. Yeah, similar to the national program, we added a slide at the beginning to show the time horizon performance by the different categories of investments in the state program to give you a better sense of what is driving performance over different time horizons. On the fund investments, we also split those by 2008 and before and 2016 and after. There were no fund investments between 2008 and 2016, but if you'll recall, there was a requirement in the program for managers to open an office in New Mexico and staff it with a senior person. And that requirement was removed, and it opened up the possibility of adding more high-quality managers to the program, which drove the reason for splitting the portfolio at 2016 when the fund investments were starting to be made again. This table shows that the positive quarterly performance has definitely been helped by the newer fund investments that had a quarterly net IRR of 16%. The new fund investments have performed well, but on a 1 year and 3 year basis, they just don't have as much weight since, again, it takes time to draw the capital and invest the capital. So they don't have as large a weight as some of the other types of investments in the portfolio. From a gain perspective, the co-investments have the largest portion since inception, but it's still largely unrealized. Turning to the next slide, we show the since inception performance for the state program. Overall, the net asset value increased by $18 million, primarily driven by both capital calls and portfolio gains. The since inception returns for this program are 1% and at 1.07 times net multiple. If you look at the graph down below, note that the 10-year return is better than the since inception return, which I think shows the improvements in the program over the last decade. But we did see a decline in the 10-year return from a 6.8% at year-end 2019 to 5.8% as of September 30th, 2020. It was not necessarily driven by losses, but just more by overall returns being lower than that 6.8%. If you turn to the next slide, 177, this shows the different components that make up the net asset value change. And you can see the $11 million of contributions and the $7 million gain on this slide that led to the NAV increase. The contributions have really been driven by the recovery fund drawing capital, and the gains are driven by write-ups in a couple of funds that we've seen. We will see another strong amount of contributions in the Q4 report with $36 million, which will be a driver of the net asset value increase for the Q4 report when we present that in a couple months. 178 shows the different components. The largest, and you can see in the upper left table there that the largest capital calls were from the recovery fund as it began investing in the prior quarter. There wasn't really anything significant to report on the distribution side. On the gains, we did have some sizable gains, mainly driven by some of the portfolio companies raising capital at higher valuations. And these gains more than offset the losses in the quarter. Page 179, we show a similar chart here from the national program that shows how the performance by vintage year compares against the Burgess North America Venture Capital benchmark. But as a reminder, this is a differential return program, so we're not necessarily looking to outperform, but we do want to see a positive return from the portfolio. 2016 in particular has been a strong year driven by the fund investments. Overall, there are a lot of below median returns because venture capital has been a strong performing asset class in recent years, but the exposure in this program is much more targeted and less diversified. And so we're not benefiting as much from a more diversified portfolio like you would if you were just managing an overall venture capital portfolio. But I think what we're seeing in the marketplace is still having a positive influence on this portfolio, as we've seen with some of the portfolio companies raising capital at higher valuations. Slide 9 shows the public market equivalent and comparing the private equity performance over the last 10 years against the Russell 3000 and Russell 2000, and there is underperformance there. And then page 181 shows the economic impact, and most of the numbers on this page have increased with the increased New Mexico investment, especially coming from the recovery fund. So if you look, the recovery funds increased the number of New Mexico companies in the program to 91, and 17 companies have received investments in the last 12 months. The total invested from the SIC is up to $312 million, and at the fund level, it's at $413 million. And $50 million has been invested over the last year. And the recovery fund is a large driver of that, but it's not the only driver. There have been other funds that have invested from the program as well. And then turning the page to 182, the number of jobs increased by almost 900, and these are jobs that are currently at the portfolio companies. And so those 900 primarily came from the companies being supported by the recovery fund. But the other statistic we track is job growth, and job growth did not change just because of the new investment, because we actually track job growth since the time of the SIC's investment, and job growth increased to 584. And to the extent that the companies in the recovery fund grow jobs during the time of the recovery fund's investment, that will be reflected in this number as well. The annualized New Mexico payroll increased to $119 million, and annualized expenditures on New Mexico goods and services increased to $63 million from the new companies as well. And the rest of the slides go into more details about the different components, but I'll conclude there and open it up to any questions anybody has.
Thanks again, Richard. Questions on the New Mexico program from council?
You know, is it okay?
Member Jennings.
Yeah, you know, it's really hard to kind of look, you know, because when we look about investments and what New Mexico does between what Albuquerque and other people do, it's, you know, Albuquerque went in and put in a plastic pipe factory that made polyethylene pipe. And all they did was, and they put it in, they made big pipe, and they gave them all kinds of tax incentives. And the only thing they did was put our polyethylene pipe in Roswell almost out of business. And, you know, that same company has been here since, the one in Roswell's been here since the 70s or early 70s. They paid all their health employees benefits for their family and for the employee. And the only thing that happened is Albuquerque came and gave all these incentives to that company, and they damn near put our little company out of business. And it's just, sometimes when you look about all this economic development, sometimes you ruin as many jobs as you create. And that whole company got all those incentives, and they were sold within 3 years to somebody else. You know, after giving them all these incentives and made everything tax-free, and my little guys are still over here just trying to squeak it out in competition with a company from Albuquerque that got nothing but free benefits from the state. I mean, that's sometimes, you know, when you look at this stuff, it's not all as economic incentives isn't always what it is. It might be good for Albuquerque, but the rest of us pay the price. Sorry, that's just an editorial comment.
Thank you, Member Jennings. Further questions? All right. Thank you very much for those reports. We're going to now move to the portion of our agenda, which is our investment votes. We will start with agenda item 3A, which is the investment committee report by Member Lavender.
Thank you, Stephanie. I don't have a whole lot to add. Vince covered a significant number of the matters, and you're going to hear from everyone coming on these potential investments. I know there are going to be some questions. So that I can put it out in front, Mike and I recommended approval of these three investments, actually all four voting matters at the investment committee meeting. So I think what I'd like to do is step back and let the voting matters come forward.
Thank you, Member Lavender. So with that, we will go to our first voting item, which is Berkshire Family Debt Fund 3. Going to turn it over to Paul and Townsend for a presentation. If we've got representatives from Berkshire on the line, you can hand it over to them as well, and then we will take questions after the entire presentation is complete.
Terrific. Thank you again, Madam Chair, and thank you, Member Lavender. So in addition to the folks from staff and Townsend this is Paul Chapman again, by the way. In addition to the folks from staff and Townsend that I've already introduced, we're also joined by Jed Gates, Managing Director and Head of Investor Relations, Eric Drager, CIO, Berkshire, and John File, Head of Debt Investments. We'll be turning the meeting over to them in a few minutes to discuss the two Berkshire debt strategies that we'll be discussing today. But first, you're going to hear from me for a second, and then from Townsend.
Just to clarify for members of the council, we will be taking these items individually for a vote.
Yes, Madam Chair, the two strategies, and some of my comments are going to address the fact that they are complementary to each other. There was a fee break associated with doing the two commitments totaling $100 million. That is quite significant. But yes, they are two separate voting matters. Shall I proceed? So this morning we're presenting proposed commitments to two Berkshire residential sponsored debt strategies. Berkshire Bridge Loan Investors 2, and I'm going to be calling that mouthful BBLI 2, and that's in the amount of $40 million, and the Berkshire Multifamily Debt Fund 3, which I'll just call Debt Fund 3, in the amount of $60 million. These strategies are complementary to each other, but we're going to ask, as I just mentioned, the investment committee to hold two separate votes. Staff intends to place these commitments in the financial assets sub-allocation of the real return portfolio. The financial assets sub-allocation, as we've talked about somewhat extensively already today, consists primarily of our MLP portfolio, but also two other real estate debt strategies. And that bucket is targeted to be 2.4% of the total fund. And so as you may have noted when we discussed the real return PMRs earlier, these funds are a good fit for that bucket as we need to generate income in that portfolio and diversify our portfolio, our holdings in that portfolio. I want to highlight the fact that Bridge Loan 2 received a buy rating from Townsend, while BBLI BBLI 2 received a qualified rating. And Jack and Seth will get into the rationale behind these ratings when they make their remarks. Both funds invest solely in multifamily debt and achieve their targeted returns by retaining a portion of the capital stack that sits behind about 60% loan to value of senior debt, but in front of about 30% of sponsor equity. In the case of Debt Fund 3, Berkshire acquires at a discount from Freddie Mac the B piece of securitizations that hold loans on stabilized multifamily properties. The return here comes from interest on the B piece of the securitization, plus an arbitrage return when Berkshire then sells these positions after seasoning. In the case of BBLI 2, Berkshire sources short-term transition loans. So these are properties that are either in lease-up or undergoing a light or a moderate renovation, and securitizes a senior position retaining the high-yielding B piece. We like both these strategies because while they offer high returns, the underlying collateral consists of multifamily properties which provide good stability of income and debt service coverage. So just a couple things to say before I turn it over to Jack on Debt Fund 3. We have significant experience in the Freddie Mac K-Series space, which is the bulk of the Debt Fund 3 strategy, with Berkshire, since this strategy was included in our prior commitments to Berkshire Multifamily Value Plus Funds 3, a 2013 vintage, and 4, a 2017 vintage, which are tracking to 12.2% and 14.8% net IRR since inception. Borrowers consider Freddie Mac debt as a must-pay obligation, since any default may bar the borrower from future agency borrowing. So this has really helped the K program experience low loss and delinquency rates relative to other CMBS investments. Berkshire has a lot of experience in the K program. They're the most active and largest B-piece investor in Freddie Mac's K program history, having executed 45 primary K program issuances since 2009. So with that comment, I'm going to turn it over to Jack.
Great. Thanks, Paul, and good morning, everyone. This is Jack Koch with the Townsend Group. I'm going to discuss Multifamily Debt Fund 3, and then I'll pass it over to Jed, Eric, and John from Berkshire to provide their prepared remarks. So, as Paul mentioned, Berkshire is forming Multifamily Debt Fund 3, which is a continuation in its series of closed-end debt vehicles, which invests in multifamily loans securitized within the K-Series products from Freddie Mac. So the SIC does have exposure, as Paul mentioned, to these particular investments through your investments in the prior Berkshire value-add multifamily series. Berkshire, as Paul mentioned, historically included it in the value-add series. However, after Fund 4, they stripped out this particular strategy into its own dedicated product. Thus, why we are here today discussing it in its only this particular investment strategy. This fund targets $1.5 billion fundraise, seeking a 6% annual cash distribution and total returns of 10 to 11% net of fees over a 10-year period. They will not use leverage at the fund level, and we'll talk a little bit about that in a moment. Berkshire, from your recollection, is a vertically integrated operator and fund manager. They've been doing this dating back to 1969, specializing specifically in the multifamily sector. Today, they have approximately $5.2 billion in real estate AUM with a total value of over $10.5 billion. So very strong exposure and deep history to the multifamily real estate market. Today, they have an investment team of 160 individuals that's led by an 8-person senior management team. All of those folks average over 25 years of industry experience. They are headquartered in Boston. However, they do have a number of regional offices around the U.S., Dallas, Atlanta, San Francisco, for example. The platform, and very importantly, we believe it's a competitive advantage for Berkshire, includes almost 590 on-site property management staff that are located across the country in the assets that they own. And it's important because these individuals are on the ground in these local markets, understanding the drivers of employment, understanding the leasing phenomenon, understanding what local renters need and want in their local communities. And so we do believe that particular aspect of the Berkshire platform is quite attractive. On the debt side, the platform includes a 5-person debt team that is housed within the firm's portfolio management group, and they're supported by the shared resources across the broader platform, including 8 due diligence individuals who assist in the loan underwriting process. And I'm sure Berkshire will discuss that in a couple of minutes. Fund 3 largely follows the same strategy of its predecessor funds, and that will be to assemble a portfolio of BP securities from newly originated multifamily loan pool securitized by Freddie Mac. So the expected execution will ultimately be a blended mix of B pieces, including both fixed rate first and supplementary mortgages. So that's the K and the KJ series. Those are typically purchased at discounts, as well as the floating KF series, which are typically acquired at par but do have a higher current income pay. So the fund will likely acquire 20 to 30 individual original issue K program securities in each one of the pools that they purchase from Freddie Mac. That's typically about a $50 million equity requirement per deal. And the allocations are expected to be very similar from Freddie Mac over the next couple of years as they invest this program. The underlying duration of those loans are typically 7 to 10 years with a very strong current pay up front. And then typically prepayments and principal repayments are expected for the second half of the fund's life. So as if you think about the overall trajectory of cash flow, et cetera, in this fund, cash up front, mitigating a lot of the J curve, and ultimately prepayment of those loans with some appreciation towards the end of the fund's life. The fund also has a small allocation, approximately 15%, that it can target to higher basis multifamily debt investments, a little higher return target here of 12 to 14% gross. That could come in the form of preferred equity investments, mezzanine, as well as other participating B notes. As always, we've highlighted a number of things that we do find pretty attractive with this individual investment. The first of which is the fact that it's Freddie Mac debt. Paul highlighted this. We do believe that the fact that we're buying this from Freddie Mac and the standards that they require to ultimately be included in these pools is quite high. We think that that's a very good credit that ultimately the fund will have exposure to. As mentioned, the yield premium here is quite strong. We also, as highlighted in the recommendation, Berkshire brings significant platform advantages and capabilities here. They also have a very strong relationship with Freddie Mac. As Paul indicated, they've been one of the largest buyers of these pieces. And in addition to that, they have a wholly owned subsidiary, Berkshire Mortgage Finance, that was an active Freddie lender for 10 years. So they also understand what Freddie requires when buying from originators. I mentioned before the unleverage, the lack of leverage at the fund level, which we think is also quite important here. Unlike some of their peers who will add fund level leverage on top of the embedded leverage that you're already getting exposure to through the loan, there are a number of peers that do that. In this case, Berkshire does not, and we believe that does remove much of the downside risk associated with these type of assets in the event that one of them would go bad that could ultimately poison the entire pool or bring down the entire pool of loans. As always, we do believe that Berkshire Debt Fund 3 does represent a compelling investment opportunity. That said, we have articulated a number of issues and concerns in the document, which you should certainly be aware of prior to making the investment. I would just highlight briefly the fact that this is a higher risk debt investment and it's in the first loss position. We've highlighted this in the recommendation, and I just highlight it because the fact is that when you look at the historic statistics of Freddie Mac debt and the very, very low default rates that this type of product possesses, it can somewhat conceal the fact that there are risks here and that these B pieces are in the first loss position if in the event that there is distress at the individual property level. And that's key here, though, because at the individual property level, these are not cross-collateralized with one another. So if you have 10 assets in the pool and one of them goes bad, Berkshire then has the opportunity to work through that individual loan, which we find compelling vis-a-vis many of their peers that then have to deal with the entire pool of loans because potentially that individual asset could bring down those 10 assets in that example. So we do believe it's largely mitigated with Berkshire. As always, any recommendation that we bring before you, it has been approved on a standalone basis through Townsend's investment committee, as well as inclusion in your portfolio, given your goals and objectives. We did receive a buy recommendation for this investment. So just to briefly highlight that, the difference between a buy and a qualified recommendation, as Paul highlighted, in this case, this one did receive a buy, where the bridge loan strategy that we were discussing in a moment here did receive a qualified. Buy means that we believe, based upon the underlying market fundamentals and the available options in the market, that we stand behind it as a fully buy, that it's a very prudent investment decision on your behalf. Qualified, we still believe it is a prudent investment decision. However, there are additional risks that you all need to be aware of prior to making that investment that bring the level of conviction, if you will, down slightly. Now that said, and I highlight again, we do believe that it is still a prudent investment decision, just being aware of those additional concerns. So with that, I am going to pass the presentation over to Jed and Eric and John from Berkshire to provide their prepared remarks.
Thank you, Jack. And just let me confirm that you can hear me all right?
Loud and clear, thank you.
Great. Well, I want to
start by introducing yourself?
I'm sorry, this is Jed Gates with Berkshire Residential Investments. And I want to start by thanking Jack and Paul and Clay for all the time and effort they've invested with us. On behalf of all of us at Berkshire, I also want to thank council and staff for having us here today and express our gratitude for your ongoing support for the $175 million of capital commitments across the 3 equity funds that SIC has invested in to date with Berkshire. We've always placed a high value in our partnership with SIC, and our team's excited about the opportunity to expand on the success that we've enjoyed together over the past 8 years. Today, we're going to be discussing 2 additional multifamily investment opportunities with you. Both are high conviction debt strategies that we believe are well positioned for strong performance in a post-COVID environment, and both have demonstrated resiliency throughout the pandemic. Each strategy is focused on institutional quality assets with top tier agency quality borrowers and provides an attractive blend of current and total returns with some significant borrower equity subordination, protecting our positions, as Jack mentioned. I know it's been a couple of years since we presented to council, so before I have Eric and John talk about the fund strategies, I thought it'd be helpful to take a minute to supplement Jack's comments with some additional highlights on the Berkshire platform. On page 240, you'll see a depiction of our national footprint. This map gives you a sense for the breadth and depth of our market coverage. We currently track operational data on over 327,000 units spread across 48 states, New Mexico included. We've made over 1,200 loans across our debt funds, and the benefit of this extensive reach is real-time access and insight into operating data across pretty much all major U.S. markets, which ultimately we feel better informs our investment decision-making process. If you turn to page 243, you'll see an overview of the breadth of the multifamily investment solutions that Berkshire provides. If you look at this table, it includes the 3 funds that SIC is invested in, Value Funds 3 and 4, and Berkshire Core Fund. Those are all seen in the middle of the table, as well as our 2 debt fund series shown on the left-hand side of the table, which we'll be talking about in more detail here momentarily. So we've always taken a multifaceted approach to investing in U.S. apartments, with deep experience investing both across that risk spectrum of core, core plus, and value add, and throughout the capital stack in both debt and equity investments. And there's a long tradition and a long experience around the debt side of the real estate investment business, which I'm going to ask Eric and John to speak to. John File runs our debt investment platform, and Eric Drager is our CIO and oversees both our equity and debt investments. I'm going to turn it over to Eric and John to talk through both these strategies with you in more detail.
Well, thank you, Jed. This is Eric Drager. I'm CIO, as Jed mentioned. Before I turn it over to John, I'm going to highlight a couple things in our investment strategy, generally the brief overview of the breadth of our team and their debt investment experience. As Jed noted, and Jack did as well, my teams in San Francisco, Dallas, Boston, and DC are utilized for support and underwriting both debt and equity investments. The debt strategies, we use this team to be our boots on the ground, serve as our market experts during the underwriting process. As Jack also noted, in addition to this direct team, our 600 people in-house property management team is tapped to monitor investments or provide support if any asset level issues arise. Our significant experience in debt investing is highlighted on page 244. As you can see, our experience is deep, with control interest in over $58 billion of loans closed and or purchased since 2009. That's collateralized by roughly 3,000 multifamily properties in the U.S. In addition to the debt history, we did own Berkshire Mortgage Finance from 1987 to 2004, which at the time of sale had originated about $22 billion of loans, primarily Fannie Mae, Freddie Mac, and HUD. And more importantly, it's where John and I both started our careers at Berkshire. With that, I'm going to turn it over to John, who will discuss Berkshire Multifamily Debt Fund 3. Thank you.
Thanks, Eric. I'm on page, this is John File speaking. I'm on page 247 of the slide deck. So as mentioned, this is a follow-on to Berkshire Multifamily Debt Fund 2 with a target raise of $1.5 billion. I do think it's important to note that over 90% of the investors in Debt Fund 2 are re-upping into Debt Fund 3. As has been mentioned, we've been the most active investor in this strategy since the program was formed by Freddie Mac in 2009. And to note, through the investments over the past decade, $236 million of those investments has been in the state of New Mexico. This is the acquisition of stabilized senior mortgages of what we consider the highest quality credit in the multifamily space, all through Freddie Mac's multifamily program. Their mission is to provide liquidity to the multifamily market with a focus on affordable housing. And I think what I'll do is now just focus on what we believe to be some of the most compelling aspects of the strategy. So I will turn to page 252 of the slide deck. This has been mentioned previously, but I think bears repeating the high quality nature of these investments, which has led to extremely low losses over a very long period of time. It is important to note that Freddie Mac has published underwriting guidelines that are managed by their regulator, which is the FHFA. So Freddie has to abide by those guidelines. Those guidelines are predicated upon performance that has been established at the assets, not projected in the future. On top of those solid underwriting parameters, as Eric mentioned, we utilize our vertically integrated platform to underwrite every single one of these investments. As I'll note in a minute, council will have exposure to a very diverse set of multifamily loans throughout the United States, all of which are individually underwritten by Berkshire. So we take a very boots on the ground approach to this strategy rather than a very macro approach. We actually physically inspect every single asset that is contained in one of these pools. As you can see in the page, the losses over several decades of Freddie Mac's multifamily program have been very low. Speaking specifically for Berkshire's experience in the program, since 2009, we've purchased over 2,000 loans from Freddie Mac. We've experienced only 2 defaults in those 2,000 loans, and only 1 loss in those 2,000 loans over that period of time. During our due diligence process, we do have the ability to remove loans from these pools prior to purchasing them from Freddie Mac, so that provides us with the ability to cull what we think might be higher risk credits from these pools prior to acquisition. I'll now turn to page 253, which just briefly describes there are 3 primary products that Freddie offers in this strategy. One is fixed rate, one is floating rate, and the other is a supplemental mortgage program. I would like to just note that Berkshire, through this strategy, has access to all 3 of these products. The combination of these products provides, as Paul described earlier, a blend of economics that are both focused on total return, with a significant portion of that coming in current income. And only having access to the 3 products can we achieve that. It is rare in the Freddie Mac space for a manager to have access to all 3. Given our experience and in our relationship with Freddie Mac, we do, and we think that that benefits the fund's strategy. And now I'll move to page 258, just to go over some other, I think, compelling investment opportunity attributes. And one of those, as you can see, which is at the bottom left corner of that page, is unique access. It is difficult to be accepted into this program with Freddie Mac because we are buying a first loss position, and because we do have the ability to remove loans from these pools. Freddie Mac is highly incented to work with multifamily experts who have vertically integrated platforms and can understand multifamily credit very well. So for that reason, there are typically only between 5 to 10 firms that are very active in this space at the discretion of Freddie Mac. So the ability to source these investments is fairly unique, and there are very high barriers to entry in this product. We have talked about our track record in the space since 2009. We have acquired over 50 of these investments and deployed several $1 billion of equity. And to date, our realized returns on these debt investments is over 20% on a gross basis. I think we've obviously talked about the high quality nature of these assets. It is important to note that there is significant equity subordination to our position at the property level, meaning the owners of these assets have significant equity embedded in them, which cushions any risk to our position. And lastly, I would just note, and I believe Eric and Paul both touched on this, Berkshire's platform being vertically integrated not only provides it with an ability to assess risk on the front end very well, but to the extent there is an issue with one of these particular assets, we have the operational capabilities to come in and operate an asset that might be in distress and protect the investment of the council. So with that, I will pause here for any questions.
So thank you to our SIC staff and for the representatives from Berkshire for being on the line with us today. What we're going to do, since we're going to vote on the multifamily debt fund 3 first, let's take questions on that particular investment recommendation from council members. Questions from council? All right, could I have a motion to approve?
I so move, Peter Frank.
Okay, but Peter.
Do I need to read this into the record, or is that sufficient?
Yes, it needs to be a proper
Okay.
motion. I'm sorry.
Okay.
Peter can do it. Peter can do it.
He has it in front of him.
Okay, I'm sure I do someplace. Based on the recommendation of the council, the council advisory committee, return advisor Townsend, SIC staff, and general fiduciary oversight of RDK, move that the state investment council approve a commitment of $60 million to the Berkshire Multifamily Debt Fund 3, subject to and contingent upon New Mexico legal requirements, New Mexico SIC council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
This is Harold. I'll second.
Okay, we've got a proper motion and a motion by Member Frank and a second by Member Lavender. Any discussion on the motion to approve this investment into Berkshire Multifamily Debt Fund 3? All right, Peter, it's a little hard to hear you also. So if we could have Terry call the roll on agenda item 3C.
Commissioner Garcia Richard.
Yes.
Treasurer Eichenberg.
I meant to tell you, he had to drop off. He's going to come back when he's able.
Okay. Peter Frank.
I vote yes.
Harold Lavender.
Yes.
Lee Rawson.
No.
Tim Jennings.
Yes.
Mike Messina.
Yes.
And Nick Tejas.
Yes.
So that is a vote 6-1 in favor of the investment.
Okay. Thank you very much, Terry. And without Tim, we still have quorum, correct?
Yes. Yes, you have seven still members on the phone.
Thank you much. All right, so we have passed that vote. Let's move on to the next Berkshire item. I'm not sure. Do we want to do a separate presentation on the bridge loan?
I think we should, Madam Chair. I think we can keep it briefer because we won't have to do. Oops. Yeah, I think it can be briefer because there's a lot of similarities, obviously, with the platform. So The thing that's kind of interesting about this is in both cases, whether we're talking about the multifamily debt fund or the bridge loan investors too, the general notion is that there is about a 30% equity slug behind us, and then there's senior debt in front of us. So we're taking that roughly the same piece in the capital stack in both these strategies, except for these are properties that are in transition. And as I mentioned earlier, transition means, let's say you have a developer who completes a property, gets it to maybe 50% occupied, but then they want to pull out their equity so they go on and move on to another, redeploy their capital to another investment. This allows them to do that while the lease up is going on. And then once the property is stabilized, then they would go seek financing from Freddie Mac. And these are all underwritten to be taken out by Freddie Mac debt. So I think the merits of this strategy are outlined well in the cover memo and in Townsend's in detail report, but I will point out the following. As a late investor into the fund, New Mexico State Investment Council will benefit from a current portfolio, which is about half of the targeted fundraise, generating a high cash yield of approximately 16% on invested capital via two successful 2020 securitizations, and there's another one in the hopper that'll be the third securitization. To the point made about the stability of multifamily, there have been no defaults or delinquencies within the pre-COVID predecessor fund, BBLI-1, or in the seed portfolio within BBLI-2. Berkshire has a exclusive sourcing arrangement with CBRE. CBRE is the largest real estate services company in the world. So CBRE will use their extensive debt platform to source transactions that will be brought to Berkshire. With 100% of the projected loans to be issued as floating debt, the investment is strongly aligned with the inflation-adjusted real return target benchmark. So with that, Seth is going to pick up this one for Townsend. And Seth, over to you.
Thanks, Paul. And as Paul mentioned, I'll skip over a lot of the sort of general Berkshire comments, but just to reiterate, I guess, a little bit about the fund and the strategy. Here, Berkshire is seeking to raise $1 billion, targeting returns in excess of 11% net of fees. And different from the prior presentation, we'll utilize leverage, likely around 70%, but up to 80% in the portfolio. They will have a 3-year investment period followed by a 5-year term beyond that. So the strategy here, I'll repeat a little bit of what Paul said and maybe elaborate. The fund will really execute on direct lending of short-term duration, so 2 to 3 year term, floating rate senior mortgages to that transitional multifamily property. So loans typically are underwritten to exit through the permanent Freddie Mac, Fannie Mae takeout financing upon completion of the business plan. Importantly, the fund will not lend on ground-up development, instead focusing on more moderate renovation programs, newly built assets that are in lease-up or have a really direct line of sight to that stability. As I mentioned, targeting 11 plus returns, 11 to 13% net return, and entirely from current income. So as stated in Townsend's report, in order to achieve this level of return in a debt vehicle, the fund will take on additional risk by adding leverage to the portfolio after making the loans. I'll talk more about this shortly, but as mentioned in the early conversation, this is really what Townsend believes being the primary risk of the fund and why it ended up being a qualified rating versus the buy rating of Debt Fund 3. So before I delve into that, there are a few highlights and important benefits of the fund. We believe Berkshire has a strong sourcing advantage here relative to their peers through long-term industry presence, their brand, their expansive network of multifamily operators and owners. And this really leads to access to deal flow, particularly for sourcing loans to finance the acquisition of really the transitional multifamily assets. This is driven by Berkshire's exclusive sourcing arrangement, as Paul mentioned, with CBRE, the largest multifamily lender for both Freddie and Fannie. And highlighting the proof of concept here is that this sourcing is already benefiting the fund, creating an existing seasoned portfolio with what we believe embedded value. So Paul mentioned this, but at year-end 2020, the fund was approximately 60% committed. It was generating cash yields in the 16% range, with early investments projected to generate a total of 15% gross return during their hold period. And New Mexico will gain access to this exposure day one. There's no true-up payment. So in other words, the SIC will have capital called quickly and you see an immediate return, both eliminating the J curve, but also mitigating a lot of risk in the fund, knowing that you're buying into an existing pool. Back to the point I mentioned on leverage and Townsend's rating of the fund. So like all investments brought to the SIC, Bridge Loan 2 was approved by Townsend's investment committee on a standalone basis, as well as on behalf of New Mexico's real return financial assets portfolio. However, it was given a qualified rating versus buy. So we've discussed a little bit of these difference in ratings previously, but I'll go over it again. The definitions are in your materials, but importantly, as Jack mentioned in his prior comments, both ratings state that an investment is suitable and approved for institutional capital, institutional investors. However, a qualified fund contains one or more really heightened risks that should be considered and identified. So importantly, New Mexico has invested in qualified funds in the past. So in this portfolio, the financial assets portfolio within real return, the Ares Enhancement Income Fund was approved in 2019. This is a qualified rated fund also due to the use of leverage in a debt vehicle. And then just last year with Bell Fund 7, this is a real estate equity multifamily fund, and which is also qualified rating due to really existing exposure to sort of pre-COVID priced assets. In the case of Bridge Loan 2, the underlying risk here is really causing that rating is the additional use of leverage, as I mentioned, on these debt investments. About a third of the total return within these vehicles is attributed to the use of leverage. And the risk when using this leverage is really the manner in which the debt facility will be cross-collateralized and in most cases recourse to the fund. Additionally, they are subject to mark-to-market margin calls. So therefore, in the event of a loan default or a margin call being triggered, the fund may have to call capital to really defend that position within the portfolio and or use cash reserves if they are sufficient there. With that said, so Berkshire has a good overall track record in the structured finance space and has already mentioned a material portion of the fund's credit exposure has already been sold off through those existing positions in the two securitizations and the one pending. Lastly, Berkshire also seeks to really mitigate the need to call capital in a margin call situation were to occur, really by maintaining sufficient cash reserves as they have in prior funds and investments. So there's obviously a lot more detail in our report. I'll stop here, hand it over to the Berkshire team, and then happy to address any questions.
Great. Thank you, Seth. And this is John File again speaking. And I am on slide 329. So as mentioned, this is a direct lending strategy on multifamily assets with a focus on senior mortgages and with no exposure to development or construction. This is fairly unique within the debt fund space, as we see many of our competitors focus both on development but also on subordinate positions in the capital stack, meaning mezzanine or preferred equity finance, of which we do very little. We are also unique to be one of the only multifamily-only bridge lenders in the space, which we believe provides us with a significant competitive advantage. What we have observed, especially since COVID, is a flight to quality in the capital markets. Multifamily being an asset class that is certainly in favor with investors. That has allowed us the ability to construct multifamily-only securitizations that have priced and generate returns that are superior to our peers. Certainly within this strategy, we try to leverage the decade-plus experience we have in the Freddie Mac program that we just spoke about in terms of our knowledge of markets, our boots on the ground, simply our investment experience within those markets, and our ability to understand exactly how Freddie Mac and Fannie Mae underwrite investments. Because as has been mentioned, we ultimately are looking at these assets to qualify for a refinance once they've stabilized by Freddie Mac or Fannie Mae, those being the two highest quality providers of multifamily capital in the United States. I think one data point to point towards that is in our first fund, we've already realized 17 investments that have paid off. Of that, 16 of those 17 investments have successfully been refinanced by either Fannie Mae or Freddie Mac. The 17th was just simply sold, so there was no ability to actually refinance it. Turn to page 340. I'm sorry, 341. My apologies. As been mentioned, the strategy focuses on transitional assets that fall into two categories. One, which would be value-add renovations, which we have significant experience ourselves within our equity funds, and the second being pre-stabilized assets. So these are newly developed assets that are going through their initial lease-up period after construction. And again, Berkshire has significant experience in its equity funds, both underwriting and operating both of these strategies. So we believe we also have a competitive advantage in terms of assessing credit risk by bringing in members of those teams, whether it's our property management platform, our development platform, or our value-add renovation team, to participate in the investment committee decisions that we have on these investments. And like the Freddie Mac program that we just discussed, this is a controlling position in the capital stack, meaning if there was an issue with one of these investments, Berkshire would be in position to be able to take control of the asset and make decisions about the loan. I mean, given our vertically integrated platform, we have the ability to do that. And finally, I'll just direct you, if you would, to page 345. And I think it bears repeating, as Seth mentioned, the seed portfolio, which is unique given that we are towards the tail end of our capital raise. For this strategy, we already have well over a year of investments under our belt in this fund. I didn't note at the beginning, but nearly 100% of the investors in Fund 1 did re-up into Fund 2. So we'd like to see that support. All of the investments that are currently in the fund are current with no delinquencies. There has been 100% performance in the fund, even during COVID. Obviously, putting significant capital to work very quickly for the council. There will be up to $400 million of equity deployed into the three securitizations once the third one is executed in mid-March. And just to touch briefly on some of the finance risks that were brought up earlier, that finance risk exists for a small period of time from when we close the loan until it is securitized. Once the loan is securitized, that risk has been sold to third-party bond investors that own the senior bonds. It is important within our strategy to ensure that we have significant investment flow so that we can securitize these investments frequently, so that we're not in that warehouse aggregation period for a long period of time and exposing ourselves to that risk. To that end, our typical period on a warehouse line for these loans, subject to that financing that Seth discussed, is roughly 2 months. So it's a very small period of time. I would also note that we typically do not take the full amount of leverage that is available to us during that warehouse period. Our warehouse lines allow us to take up to 80% advance rates against these loans. We typically take closer to 70 to 75% to provide ourselves with some cushion in addition to the additional cash that we hold on hand, as Seth mentioned. And I would note that we did have this warehouse exposure about a year ago prior to COVID. and we're able to manage through that warehouse exposure during COVID until we were able to securitize the investments when the market came back in June of 2020. So during that period of time and the depths of the crisis, we did not experience any mark-to-market margin calls on our warehouse lines, which I think speaks to the high-quality credit of the underlying assets and the reasonable approach that we take to our warehouse leverage on them. So with that, I will pause here and hand it over to Eric for any concluding comments before we take Q&A.
Thanks, John. This is Eric Jagger one more time. I think I'd like to summarize the presentation, note some complementary features and competitive advantages of these investments, and you'll see these noted on page 348. First and foremost, I think, is high-quality credit underwriting standards. I think we spend a lot of time focusing on sponsor, trying to take exposure to larger, more liquid markets, institutional class real estate, and benefit from our historical agency due diligence and thought process. And then again, to reiterate, using the boots on the ground to really look at the assets and come to conclusions. Unique deal flow is important. We do have access to CBRE's deal flow, and our hit rate is about 10%, which shows we've got the ability to be both selective but also provide volume. Strong equity subordination, which has been mentioned quite a few times before. Control, with the ability both to make decisions, but then also execute on a decision as it's needed. And then finally, diversification. This fund, we think, will end up with over 200 loans at the end. So I think with that, I'd like to thank the council for its time and invite any questions.
Thank you, Mr. Dreger, Mr. File, and I'm glad you addressed the issue that staff brought up in terms of the risk and the timeline around, the exposure to that risk is a shortened timeline. So I appreciate you asking that or responding to that, because that was going to be, I'm sure, a question from council. But let's see if there are further questions on the Bridge Loan 2 investment recommendation. Questions from council? All right. If not, I will take a motion.
This is Harold. Based on the recommendation of the Council Investment Committee, Real Return Advisory Council, SIC staff, and general fiduciary oversight of Aque, I move State Investment Council approve commitment of up to $40 million to Berkshire Bridge Loan Investors 2, subject to and contingent upon the Mexico legal requirements, the Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Thank you, Member Lavender. Do we have a second?
I'll second. And we'll second.
Okay, I hear both Member Messina and Member Jennings with a second. And so with that, do we have discussion on the motion? All right, we'll have Carrie call the roll on a motion to approve Berkshire Bridge Loan Investors 2 $40 million investment.
Commissioner Garcia Richard?
Yes.
Peter Frank?
Yes.
Harold Lavender?
Yes.
Lee Rawson?
No.
Tim Jennings?
Yes.
Mike Messina?
Yes.
And Nick Tejas?
Yes.
Madam Chair, it's a 6-1 vote for approval again.
Okay, thank you very much, Carrie. Thank you to staff and Townsend and our representatives from Berkshire for being on the line to take questions today.
Thank you, Madam Chair. Thank you.
Thank you very much.
So we're going to go to investment recommendation for Scout Ventures 3. I'll turn it over to David, and you can take it from there.
Thank you, Madam Chair. Staff and the consultants are joined by the managing partner of Scout Ventures, Brad Harrison, and another partner of Ventures, Wes Blackwell. The materials start on diligent page 367, the due format. They have a staff memo, a due diligence report from Mercer right behind it, and then behind that, a presentation from Scout Ventures. And we'll have Chris Cassidy walk us through some summary comments and then turn it over to our consultants. And finally, Scout Ventures. Go ahead, Chris.
Thanks, Dave, and good morning, everyone. This morning, we're recommending a $5 million commitment to Scout Ventures 3. The proposed commitment would be a fund commitment under the New Mexico program. This would be the SIP's first commitment to a fund sponsored by Scout. In the New Mexico program, we're always on the lookout for managers whose investment strategy fits well with the types of opportunities available in New Mexico, which skew more towards hard science, given the national labs here and organizations like the Air Force Research Labs. Scout is an early-stage venture capital firm that targets the intersection of three things: advanced frontier technology, technologies that have dual uses that can be used in both commercial and government markets, and experienced, hard-to-access founders that are exiting premier research labs, the military, and the intelligence community. Most of Scout's investment professionals are either graduates of the military academies and therefore served as officers in the military, or somehow involved in the intelligence community or other government agencies. Therefore, they maintain a really interesting differentiated network of relationships across a diverse group of entities, including national research labs and private research labs, the intelligence community and other government agencies, military R&D labs like the Air Force Research Lab, national security and innovation groups, and other academic R&D labs. Scout is already active in New Mexico. They invested last year in a Los Alamos company called Ubiquity. In addition, they've reviewed more than 20 investments in the state, and they're looking to make more investments over the next couple of years. I'll turn it over to Richard Pugmire from Mercer to go into the investment in more detail and discuss their diligence findings.
Thanks, Chris. Like Chris said, Scout Ventures Fund 3 is a new relationship for the SIC and the first commitment from the New Mexico program in 2021. Scout Ventures focuses on seed and early stage venture capital investments in technology companies that are coming out of the military, intelligence, and research communities. And it focuses on various sectors, including security, robotics, drones, artificial intelligence, quantum computing, and blockchain. Chris did a good job summarizing the fit with the New Mexico economy. So I'll summarize our report and the research that we did on Scout Ventures. To summarize what we like, the team has expertise and a background with the institutions they're targeting for technology ideas. Multiple people on the team have had careers in the military or with the U.S. government before joining the firm, which has led to strong relationships in those sectors, which are in turn strong benefits for the portfolio companies that they put in their fund. They've utilized this background to build a strong network for sourcing, and we see through their efforts in New Mexico how they are active in trying to find new technologies. One item to note is that they have been successful at helping facilitate companies receiving non-dilutive financing, such as government grants. This can be a complex process, and they've helped their companies raise a sizable amount of this form of investment. From a track record perspective, they have a number of companies that have generated strong returns to date, with a since inception return of 21% net IRR and at 2.4 times net multiple. Note that a majority of the investments are unrealized, so there can be volatility in the ultimate outcome. There are a number of areas of concerns that we highlight in our report as well, given the strategy and the smaller size of this firm. But I think this assessment also drove sizing the commitment for the risks with a $5 million commitment. Consistent with what we see in seed and early stage venture capital funds, there is a high loss ratio, and strong performance is reliant on a number of companies outperforming, which Scout has been able to do so far. They've also been able to focus their strategy more. The first funds were also focused on media and e-commerce platforms. The frontier technologies that they are focusing on can be volatile, but if successful, they can bring a large return. But there are going to be losses with this strategy as well. One note about Fund 3, which is the fund that the SIC will be going into, it's already made 15 investments and is marked at a net multiple of 1.2 times and a net IRR of 12.5% as of September 30th, 2020. The SIC's commitment will come in at cost with no penalty on subsequent capital calls, which is favorable to the SIC. The gain is unrealized, so ultimate performance is still unknown, but that is a positive for coming in late in the fundraise. I'm going to turn it over to Brad Harrison, who's the founder of Scout Ventures, for a short presentation now.
Hi, this is Brad Harrison. Madam Chair and members, thank you for your time today and the opportunity to share what we are doing at Scout and in New Mexico. Scout Ventures is an early-stage venture capital firm that cultivates frontier and dual-use technologies built by experienced, hard-to-access founders exiting the military, intelligence community, and premier research labs focused on making the world a better, safer place. At Scout, we have an experienced team of investors, operators, and entrepreneurs with broad geographic reach through a presence in Boston, Chicago, New York City, Washington, D.C., and our headquarters in Austin, Texas. The geographic distribution is deliberate in nature and part of our effort to be closer to both the underserved and high-potential technology markets where there is talent to match, New Mexico being a prime example. To date, Scout has invested in over 80 companies with 18 exits and counting and 2 unicorns, ID.me and Unite Us, which we proudly incubated out of our Scout office. Over the life of the firm, we came to realize that our best performing deals had a variety of traits, but at its core, they were founded by entrepreneurs that we now call hard to access. Founders that are veterans of the military, intelligence community, and preeminent research institutions and national labs like Los Alamos and Sandia. With that in mind, you can see why we believe New Mexico is a natural partner for us as we double down on this strategy. We believe that we are uniquely positioned to help New Mexico-based companies succeed while executing on our thesis. To execute on our strategy, Scout has assembled a team of truly unique backgrounds in the venture ecosystem. First, I am a distinguished honor graduate of West Point, after which I served as an airborne ranger. After the military, I attended MIT Sloan, where I focused on new product and venture development, fueling my passion about technology, venture capital, and entrepreneurship. Following MIT, I had multiple operator roles, helping scale 2 startups, and I also worked for Ted Leonsis, the vice chairman of AOL. Throughout these experiences, I was an angel investor, which led to my founding Scout in 2011. Furthermore, my business partner, Wes Blackwell, who's also on the call, has a similar background. He has led small elite teams and has also been key to scaling several companies. He's a Naval Academy graduate, flew naval helicopters for over a decade doing counter-piracy as well as combat search and rescue. He finished his active duty time doing missions and teaching leadership at the U.S. Naval Academy. This was followed by stints in private equity and hypergrowth startups. This led to him angel investing in founders coming out of the military, intelligence, and research communities, which is how we met. The rest of our team is equally impressive. It includes other military veterans, former intelligence officers, and other team members with finance, fund administration, and investment banking experience. We have also recently taken a leadership role in leveraging these networks that we have informally belonged to over the years. First, we help launch and fund a platform that leverages the talent pool and network of military service academy graduates to identify, syndicate, invest, and support veteran-led companies called the Academy Investor Network. Second, we invested in a vertically integrated holding company that invests in space sector called Voyager Space Holdings. Scout's thesis targets the intersection of advanced frontier technologies with dual-use applications, meaning all of our current fund companies have government and commercial applications built by the aforementioned hard-to-access founders. We believe that the New Mexico ecosystem is key to us executing this strategy. The high density of PhDs, research, university, and military labs is ideal for Scout. As such, I think it would be helpful to let you know what this looks like in practice as we further embed in the local ecosystem. In 2020, prior to the start of the pandemic, we were in New Mexico on the ground in both January and February. In the last year, the Scout team has completed initial and follow-on investments into a local company, Ubiquity, attended board meetings, served as a panelist at local pitch competitions, most recently the Hyperspace Challenge, sourced new potential deals, mentored and assisted multiple companies, and established a regular cadence of engaging with local investors, university, and various research labs based in New Mexico. Scout has already led a deal in New Mexico and is in due diligence with multiple other New Mexico-based companies. We invested $1 million into Los Alamos-based Ubiquity, a material science company that manufactures stable and non-toxic quantum dots designed for agriculture, security, and solar power applications, and it remains one of the largest positions in our current fund. We continue to actively participate in the company's growth, attend board meetings, hold regular check-ins with the CEO, introduce the company to other potential investors, and refer job candidates to help build the team. We are encouraged by the continued progress the team is making and anticipate participating in future funding rounds for the company as they continue to generate more revenue and contribute to the growth of the local economy. We are pleased to say that Ubiquity has 19 highly qualified New Mexico-based jobs, and that number is growing. Ultimately, we look forward to replicating their success with other New Mexico-based startups as we continue to explore investments in the state. We are establishing a regular cadence to engage with various stakeholders in the New Mexico technology ecosystem. This includes Los Alamos National Lab, where Ubiquity was started, Sandia National Lab, Air Force Research Lab, Army Applications Lab, NASA, UNM, New Mexico Economic Development Council, New Mexico Angels, Iron Creek, Sun Mountain, amongst others. This activity has led us to evaluating over 20 New Mexico-based investments in the past 12 months alone and resulted in the first investment in Ubiquity. We've joined the New Space Alliance of New Mexico, which helps grow and support the space industry in New Mexico. We also have regular reoccurring calls with various research institutions, such as Los Alamos, UNM, and AFRL, where we assist them by mentoring, sharing our network, and ultimately helping them commercialize their technology. We are extremely excited about this opportunity to collaborate further in New Mexico. I'm happy to answer any questions you may have, and thank you all for your time.
Thank you, Mr. Harrison. And before I open it up to questions from council, I should just let you all know we do have a number of folks on this call who sit on council that are very interested in increasing our investments into New Mexico companies. I'm not sure if you were on the call earlier, but there was some comments about just ensuring that we have geographically diverse investments and we're not just hyper-focused on the Rio Grande corridor, which folks tend to do. So I would just tell you, in addition to the institutions that you mentioned that you are reaching out to, which I'm very happy to hear about that. I mean, it's great to hear that, like, you have already been on the ground, you know who the players are. There is an Air Force base outside of Clovis. There is the Waste Isolation Pilot Project, which is the DOE facility down in the southeast part of the state. So there are other, I think, potentials possibly for tech transfer and spin-offs from work that's being done at DOE facilities throughout the state. So I would just encourage you to have kind of a geographically diverse approach when you approach New Mexico. I don't know if you have any comments on what that could look like at this time, but I'm very excited by this investment. I wish it could be more, but I have been told by our staff that it is right-sized for the risk, so I will be happy to support it as it stands. Questions from council on the Scout Ventures investment? No questions.
I have a question, Peter.
Member Frank.
Yes, could you comment on why the capital raise has been so difficult for you?
This is Brad. So what really happened was we were on track and we had several institutions, and quite frankly, COVID kind of suspended most institutional investments. So we basically delayed the closing of the fund to make room for the time to work with New Mexico, Mercer. And so really it's been a lot longer, but that's because we basically put everything on hold due to COVID.
And where do you stand currently? What's your expectation of hitting the $50 million?
We're on track. We're at about 32 now with about another 17 closing, we hope. 15 to 17. So we should be close to the goal. And we're closing March 31st.
Okay, thank you.
Thank you, Member Frank. Further question? No, if not, we're I'm ready for a motion.
This is Harold. Based on the recommendations of the Council Investment Committee, Private Equity Advisor Mercer, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve commitment of up to $5 million to Scout Ventures 3 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Thank you, Member Lavender. Do we have a second?
I'll second it.
Okay. Second by Member Messina. Thank you. We have Carrie call the roll on a $5 million investment in Scout Ventures 3.
Commissioner Garcia Richard.
Yes.
Peter Frank.
Yes.
Harold Lavender.
Yes.
Lee Rawson.
Yes.
Tim Jennings.
Yes.
Mike Messina.
Yes.
And Nick Tejas.
Yes.
Madam Chair, you have a unanimous 7 to approve.
Thank you, Carrie, and thanks to our representatives from Scout who are on the call. Okay, so that concludes our investment votes. Next, we have a manager contract renewal vote. That's agenda item 3E, and I'll turn it over to Starla.
Okay, this is Starla Bennett, and this memo is on diligent page 444, and we are recommending a 2-year contract renewal for international public equity manager Alliance Bernstein, who manages 2 passive strategies. Both strategies have performed as expected. There haven't been any significant changes at the firm, nor any violations of the SIC's investment policy, and a manager profile follows this memo. Those are all my comments.
Thank you, Starla. Are there questions from council on this readout? All right, I believe this is a vote. Do we I have a motion to renew our contract for international?
Madam Chair, this is Harold. Based on the recommendations of the Council Investment Committee, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve the renewal of a contract for international equity manager Alliance Bernstein LP for a period of 2 years, as memorialized and discussed by the Council at today's meeting.
I'll second. Okay, we have a proper motion by Member Lavender, a second by Member Messina. We can have a roll call by Carrie on agenda item 3E.
Commissioner Garcia Richard.
Yes.
Peter Frank.
Yes.
Harold Lavender.
Yes.
Lee Rawson.
Yes.
Tim Jennings.
Yes.
Mike Messina.
Yes.
And Nick Tejas.
Yes.
Again, Madam Chair, unanimous approval, 7-0.
Thank you, Carrie. Next, we'll move to agenda item 3F, which is New Mexico Retiree Healthcare Authority Transition Memo, also from Starla. And it doesn't say that this is a voting item. Could I get guidance from Steve? Are we voting on this, or is this informational?
This is an informational item only.
Okay. Thank you, Starla. You can proceed.
Okay. Well, the transition actually went really well, and Clayton Cleek implemented the transition, and I'm going to ask him to give you the details.
Hi, this is Clayton Cleek. In early January, the SIC transitioned equity assets on behalf of New Mexico Retiree Healthcare Authority. For efficiency, we also transitioned around $60 million on behalf of the permanent funds to move closer to the emerging market allocation approved by the council in 2020. This was across two transitions, which you see in the memo, Transition 1 and Transition 2. The SIC elected to work with Citigroup Global Markets for the transition. Both transitions came in within expected costs. The first transition, approximately $60 million in the U.S. small mid-cap active pool, and the second transition in the non-U.S. emerging market index pool. Further detail on the costs and the post-trade analysis is shown in the memo. Happy to answer any questions at this time.
Thank you, Clayton. Any questions from council? We'll move on to agenda item 4, finance matters. We're going to start with an audit committee report from Member Frank.
The audit committee met a few days ago and reviewed the appropriation request process. You've heard about that already, or you hear about it from Brett. We also talked about the upcoming RFP for renewal of our external audit services. That's hopefully our second term with our present supplier or whomever else bids on it, depending on how that process goes forward. We discussed cybersecurity penetration testing. We were assisted in that discussion by our new audit committee member, Mike Everett. A budget report from Brett showed that we were on target. And we discussed the compliance work by Colmore, which acts in effect as our major internal audit function, and their success in being a value in watching our fee structure and watching our private equity and other investment partnerships. And we renewed that contract. I'll take any questions.
Thank you, Member Frank. Any questions for the audit committee? We thank you for your service on the council and specifically your capacity as vice chair and vice chair of the council, and also heading up the audit committee, Peter. So I'm sure that others will add their accolades, but I just wanted to let you know how much you are appreciated.
Well, thank you.
So if there's no further questions for the audit committee, we're going to turn it over to our Chief Financial Officer, Greg Shipp, for his CFO report.
Yes, Madam Chair, I'll be really brief today. I'm on page 448, and I really don't, unless there's questions, have anything to add on the budget to actual or the investment holdings report. I did want to emphasize, as I think I've mentioned in the past, the agreed upon procedure reports for the first 2 quarters of the fiscal year are targeted to be completed by the end of March. samples have been selected. We've sent out emails to our managers, and that process is going well. The one thing that we do have to address today, and I want to turn some time over to Bruce Brown, is item number 4, which is the Colmore contract renewal.
Yeah, and that is a voting item, so I appreciate you giving us ample time for that. So before we go on to Bruce, any questions for Brett? All right, Mr. Brown, are you ready to present?
Yes, thank you, Madam Chair. So this is a contract renewal issue. Colmore has now worked for us for 3 years. They've done excellent work. They're currently monitoring about 230 private market funds, monitoring the fees, going through both what's given to us in terms of fee breakdown and in terms of what appears on their capital account statements to give us a very detailed look at what's going on. The nature of private market funds is often opaque, and it takes a lot of work to go through the actual account statements to pick out exactly what we're being charged and what's reasonable. And Colmore has done that. And as I mentioned in the memo, they've generally found everything to be going just fine. We're paying fees we would expect to pay, and our fund managers are acting appropriately. Every quarter they produce a report for us that gives funds that they're paying particular attention to because of things that look out of order to them. In almost all cases, they've turned out to be worked out fine. Sometimes there are minor discrepancies in what they expect and what they find, and we've been able to work all of that out with our fund managers. As a major deal for them, they were able to find one discrepancy, which, when we recouped the funds, basically paid for their entire 3 years of work. So it's a very useful service in terms of compliance. It's showing us what we want to find, and for that reason, I would ask that we vote to review their contract. Thanks.
Thank you, Mr. Brown. And just to clarify for both council members and any members from the public that are listening in, this is for another 3-year term, and the charge is roughly $255,000 annually.
That's correct. And it'll depend slightly it'll change slightly depending on how many funds per quarter they're monitoring.
And this is a service that audits our private market fee collection and validates our interactions with those folks. That's my understanding.
Yes.
Any questions for Bruce?
Madam Chair, I'll make a motion.
Okay, Member Frank.
Based on the recommendations of the Audit Committee and the SIC staff, I move that the State Investment Council approve the renewal of a contract with Colmore for private market fee collection and validation services for a period of 3 years, as memorialized and discussed by the Council at today's meeting.
I second it, Madam Chair. Nick Tejas.
Okay. All right, we've got a proper motion by Member Frank and a second by Member Tejas. Any discussion on that motion? If not, we will move to carry for a roll call vote on the contract renewal for Colmore.
Commissioner Garcia Richard?
Yes.
Peter Frank?
Yes.
Harold Lavender?
Yes.
Lee Rawson?
Yes.
Tim Jennings?
Yes.
Mike Messina?
Yes.
And Nick Tejas?
Yes.
Again, a 7-0 unanimous approval.
Thank you, carried. Okay. With that, we'll move to agenda item 5, closing matters. Is there any old or new business before the council today?
Madam Chair, this is Steve, if I may.
Yes, Mr. Marie.
Thank you.
And speaking on behalf of the council staff this morning, Peter Frank was appointed to the council in June of 2009. He took on the difficult task of working with the legislature to statutorily restructure the council to facilitate major changes in staffing. Both of those were implemented during the time frame 2009-2010. As the commissioner mentioned a little earlier, Peter served as our vice chair, as chair of our audit committee, and his expertise as a CPA and a former global leader of PricewaterhouseCoopers, PwC, as a corporate board member, as an investor, has contributed immeasurably to the professionalization of the management and the oversight of the operations of the permanent funds, and to the increase in the contributions the funds make to the state. Today will likely be Peter's last meeting. Senate confirmation of the governor's appointment of John Ulrich as Peter's successor is expected before our March meeting. So again, speaking on behalf of the staff, we want to thank you, Peter, for your unwavering commitment to our mission and for being a stellar member of our council.
Madam Chair, this is Harold. I would like to second what Steve just said, if I could, and to, when I joined the council in 2011, Peter and Lee were the two who were on the council at the time, who are still on the council. I think Peter's counsel has been absolutely invaluable. I think the fact that he pays attention the way he does and asks the kinds of questions that he has, I'm going to miss him. Going to miss his sage advice. He's also a personal friend, and I know I'll see him in the future, but I just want to add my thanks to everything that Peter brought to the council and everything he's done for the state of New Mexico.
Thank you, Member Lavender.
This is Lee. I just want to know, Peter, it's just been a real privilege to work with you, and I appreciate all your insights and the courtesies you extended to me.
Thank you, Member Lawson.
Just Tim, the other Tim. Peter, I just want to say thank you. You certainly told me a lot. I still don't know much about all this stuff, but I do appreciate it, and thank you for all your service and getting us through some dark times. Thank you, Peter.
Thank you, Member Jennings. Member Frank, would you like to say a few words at this time?
Well, I so much appreciate the commentary from everybody. It has been personally very satisfying to serve this council. I joined at a very turbulent time, and almost immediately I formed the audit committee, which then became the investigation committee, which led, as Steve mentioned, to the restructuring of the council. And I won't belabor all that history, but I have gone back and read an extensive report that we wrote in February of 2010, which set a blueprint for the council and for our agenda. And it might be useful for people to take a look at that because of its historical significance and also that it's still relevant. But since that date, with Steve and Vince, our performance has been extraordinary. And more importantly, we have no headline issues, which will make Charlie very happy. We are no longer the troubled SIC, and the council should be very proud of our success. Thank you all for being such good colleagues and for listening to me on occasion. And I wish you all well. Thank you.
Thank you, Member Frank. And I actually would like to request that staff send that report out, that 2010 report that you're referencing, just so those of us who are more Johnny-come-lately can refresh our memory on how far the council has come from, yes, the days of scandal and just, proper thanks and due acknowledgement to all of those who participated in the efforts to turn the council around and make it the body that it is today. So I won't skimp on my gratitude and acknowledgement to you, Member Frank. Thank you so much.
We'll certainly do that, Commissioner.
Thank you, Steve. Any further old or new business before the council? All right, with that, our next SIC meeting is Tuesday, March 23rd, I believe, still telephonically, unless we hear otherwise. And with that, we'll go to agenda item 6, public comment. Charlie?
Madam Chair, there's no public comment to be was submitted at this time.
All right, I guess everyone's distracted by the legislative session. With that, I will take a motion for adjournment.
Harold, so move.
Second.
All right, a motion and a second. Any objection to an adjournment motion? Thank you, folks. With that, we are adjourned.
We'll see everybody.